Hi, my name's Tom Elliott, Director of Beulah Capital. Welcome to our quarterly investment update. With me is our CEO, Christian Ryan.
Thanks, Tom. Thanks for being here today. Look, last time we spoke, a number of months ago, Trump was high on the agenda. Since then, how's things played out with Trump and what he's up to at the moment?
Well, the White House looks like a mess right now. We had a press secretary, Sean Spicer, for 6 months. He resigned or was sacked. Then he appointed another guy, hedge fund manager, as luck would have it, Anthony Scaramucci. He lasted, I think, all of 10 days. So it's just chaos in the White House. But the fact is this, the American stock market keeps rising. So as usual, the business of America is business, and Americans don't seem too worried about some of the funny things that Donald Trump says and does.
Probably bring it a little bit closer to home, but also around the world, we have our reporting season where a lot of companies get to sort of update investors. Can you just firstly explain what is the reporting season? What does that mean for investors?
Okay, so most Australian companies do 2 big profit reports a year. They do updates and all that sort of thing all the time, but they have their interim results, which are usually till the 31st of December, and then they have their full year results, which come out after the 30th of June. So what we're seeing at the moment is the full year profit results, and typically they're released late July, early August. Not all companies report around this time, but probably 70 to 80% do. And it's a very intense time in the stock market. It's sometimes called the confession session, because if companies have got something going wrong, this is their chance to update the market. And for example, some of the interesting results that we've seen, Telstra, for example, is battling with the NBN and trying to retain customers. Most people, myself included, think its dividend will have to be cut. And it's interesting, as Telstra edges down to $4 a share, I think its maintainable dividend is 20 cents a share. So 20 cents divided by $4 is 5%, fully franked. That's probably the real yield on Telstra. Commonwealth Bank is in the wars at the moment. They've been accused of all these money laundering offences, and I reckon Ian Narev, the CEO, might lose his job at some stage. It also means there'll be a royal commission into banks. But the standout probably in terms of good results was Rio Tinto. Iron ore prices have been strong, coal prices have been strong. It's paying down debt. It's increased its dividend massively from, I think, 45 cents to US $1.10 a share. So, the focus on dividends, I think, is pretty important in this reporting season.
And if you could just name one issue you think that investors should be maybe sort of giving some attention to this reporting season?
I think you always look at cash flow. I really do, because cash flow is the lifeblood of companies, whether they're small or whether they're big. People get obsessed with the profit numbers, but the amount of cash a company is generating, and therefore its ability to do things like pay down debt or increase dividends, that's the key. So I look at free cash flow generated by companies. Doesn't matter if they're telcos, banks or resource companies, that's a key measure for us. Okay, so Christian, our clients of course have a lot of diversified portfolios that we manage. What are some of the key strategic trends that you're looking at?
Well, as you said earlier, Tom, America has been doing a pretty good job, and to be honest, we've actually been slightly reducing our position in America, more in favour of other countries such as Europe and emerging markets. And look, the main thing that we've seen over the last number of months is that broad growth across the world is really starting to move along. Now, not saying that US is not a great place to invest, but we just feel that Europe is probably a number of years behind the US, and even to some extent the emerging markets has always been a strong growth area. So over the last number of months we've been positioning ourselves a bit more in Europe, and emerging markets. Probably a little bit closer to home, one of the areas that we've started to invest in here in Australia is technology, and one of the businesses that we did add to the portfolio is NextDC, which is data centre. Data is doubling every 12 months, and to be honest, if everyone thinks about Amazon's biggest, most profitable part of its business is actually data centres. So Australia's starting to at least get a position in sort of good technology type businesses. And probably the third one that's probably keeping us up a little bit is the whole Amazon effect. We've seen the market price down dramatically retail property businesses and also retail stocks, and I think it did get overdone, and we're starting now to see a bit of a rebound. However, it has highlighted the issues is the interruption of technology, and what does that mean for Australian corporates that have had such a strong foothold on the Australian consumer for a long time, still quite profitable businesses. But, we know that are coming. I think people do overact a little bit, but it's certainly an issue that, from a strategic perspective, we need to strongly consider.
Okay, so if we went outside the mainstream, what's an investment theme or something that you're looking at that perhaps other people are not?
Look, I think this certainly from my perspective, our perspective, renewable energy type of investments is, I wouldn't say high on the agenda, but is on the agenda. It's an area where as more and more capital, and there's a lot of money that needs to be invested. Renewable energy such as battery technology, which is able to store solar, is a really interesting area. I still think it's got a long way to go. We see Tesla and Elon Musk really dominating the headlines and the press and promoting it. But certainly renewable energy is an area I think over the next number of years will certainly become more of an interesting investment that we'll be considering.
Well, from my perspective, I went shopping with my young daughter yesterday, and we happened to go into JB Hi-Fi, and we had to buy a new iPad and a few other things. Anyway, she ran over to a corner of the store I had not seen before, and it's got a sign above it. It says robotics, and you can now buy for a few $100 little robots that run around the house and do things. Now these are at the early stage. Allied with it is things like drones, but I reckon robotics is going to be a game changer, I really do. And I was just very struck by the fact that she, as a 7-year-old, said, yep, that's what I want. I'm going to save up my pocket money and buy a robot. So I reckon that's the trend to look for in the future. Anyway, thank you very much for your company, and we'll talk to you again in just 3 months' time. Thank you.
Thanks, Tom.